So already we can see three completely, not completely, but fairly different business models and approaches and how people work, different size work with companies. And so I think as the companies approach the whole raising money in either question, you have to actually pay attention to exactly how these sites work with you and how the money actually gets raised, how much, what stage, and what's the process. So let's turn our attention to the investors for a while. Katie, I'm curious about yours in particular, since the other two, either Andrew would actually make decision on his own or with his team, and so there's already a judgment about criteria and all that stuff about what deals come through. And Jilliene has a curated process. How do you guys vet the deals that you decide to feature?
Yeah, and just to be clear, we have a heavily curated process ourselves. So we've seen over 2,000 companies, and about 2 to 3% of the companies that we see actually make it onto the platform. So we have a process that we go through. We are former private equity professionals within consumer, and so we look at it from an investor standpoint as well. We're feeding both sides, so we're helping the companies to raise capital more efficiently while helping investors to find access to opportunities that we think are interesting within the consumer space. And so we do have a heavily curated process. And then once we decide to work with a company, they go out to our investor base, and we provide those investors, or the company provides those investors through our platform with the documentation that those investors need to do their diligence. So part of that is the presentation, financials, and the offering documents. And then investors also can ask questions through our online forum, which adds a lot of transparency to the raise. So in an offline world, an investor asks a question, that investor gets that answer. Other investors that weren't on that call or weren't on that email chain didn't get that answer as well. And so we've found that having these conversations through the online platform has added a lot of transparency for investors.
Meaning one can go back and check the...
So all investors will see the forum, the questions that other investors ask, and the corresponding answers from the company. And so if an investor didn't think to ask that question, they benefit from another investor having known to ask that, and then they can see the answer from the company. And a lot of times in an offline world, that would not be the case.
Andrew and Jilliene, could you also talk about how investors interact with the companies on your platform?
Good. All right, so to repeat one obvious point where we curate our deals highly, obviously, we pick the deals. And the conversations we have with the companies and the investors are a bit situation dependent, depending on the company, the round, the VCs involved in the deal, the kinds of information flow the companies are comfortable sharing. And we mediate the conversation generally with a webinar and with phone calls. You know, part of what we do, we haven't talked about the investor base, but it really matters, right? So in our case, we screen our investors rigorously. We don't want high maintenance investors. We want folks who have the capacity to write at least 50K checks, do it at least 10 times in 10 companies, and do it again for follow-on investing. And the people who come in, it turns out, none of them live in California. Let the silence just like reign for a second. That's a surprise. We hadn't expected that. And they're often busy people running companies, and they trust us. So the process so far has been with these 6 deals that we're pushing our investors to do more diligence. We're pushing them to read the materials, to get on the phone, to actually communicate with these companies more than they do. So careful what you wish for, right? They're not high maintenance at all. They're almost too low maintenance, and they're almost irrationally optimistic about the world we're in. So that's been a surprise to me. And I guess one more thing I'll say is when we went online, we began to meet some new investors, folks who've built companies and sold them in healthcare, and their sweet spot is different than ours in some cases. And so there's a conversation around the curation side of it. I can see that our curation will change a bit as we get some very smart people around the table who understand company building, slightly off our sweet spot, and we can help figure out ways to do deals we may not have done.
Liability?
Of course we do. Of course we do. So by the way, every investor gets a 200-page document full of disclosures. And I say you have to read all of that. It basically says you will lose all of your money. I'm a venture guy, and that's the world we live in. We have to disclose all the risks constantly to everyone, and I think for everyone in crowdfunding, anytime you do a security offering, this is the deal, right? It's risky. You have to have lawyers around the table. I pay mine a lot of money, and he's worth it, right? And you guys are the same, I'm sure.
We spend a lot of money on legal bills, I can share
Yes.
that much. As far as interacting with our investors, we also use webinars, like Andrew mentioned, and those have been incredibly valuable, allowing investors to essentially get in front of the real estate companies in the online world, so not physically. But there's also this interesting offline element. I speak at a lot of events, and I fly all over the country and all over the world doing events, and at almost every event that I go to now, there's an investor who has invested with us, and who will walk up to me and say, you know, I invested $25,000 with you, and now that I've met you, I'm going to go back and do, you know, 100 or 200 or 300, which is really interesting because I'm not sure that a lot of entrepreneurs who are running crowdfunding companies are adapting to this online-offline model. I think that at the end of the day, investors still want a level of comfort. They still want a person that they can point to and say, you did the underwriting, you're managing that company, you're setting the culture at that company. I think culture is incredibly important at crowdfunding companies, and we've spent a lot of time and energy building our culture, which, you know, similar to Andrew, is there are no sales at our company. We are never selling any investor on anything. We're fully disclosing everything. We're providing them incredible customer service. When you call our business, somebody actually picks up the phone. So there's really this offline component of it. And there's another word that Andrew mentioned, which is trust. Trust is incredibly important in this industry. And I think that we've started to build some trust with a lot of our investors. I mean, we'll have investors who will do $1 million, $2 million, $500,000 with us. And these are folks who may have never met us offline, but have now gotten comfortable with us online, and that I will probably meet over the next year or 18 months. And it's all about building trust as a crowdfunding platform. And I think also as an entrepreneur. I mean, when we were raising our round for our business, which was in the angel round and in the VC round, it all came down to trust. It all came down to investors who you get to know, investors who you get to trust. And even though there's this online component, I think it's very similar in the offline world.
Debbie, anything else you want to add?
No.
Okay. So let's talk about the investors. Now that Andrew's answered this question, let's talk about who actually participates. How do they find you? You know, what are they like? How much do they invest? Is there a limit? And for that matter, let's just touch on the legal aspect. How are you complying with Jobs Act, and what, you know, to what extent will you go in terms of raising money? Who will you take money from?
I can start if you guys want me to. I wish I knew who our investors were collectively. I mean, honestly, we have individuals from almost every single state in the country who are investing with us. We have a really, really wide range of ages, from young people to old people. You know, the one thing they all have in common is that they're accredited investors, and we screen vigorously as well, like Andrew was mentioning. But they totally vary. I mean, we'll have an engineer at Facebook investing with us, and we'll have a top-tier real estate broker investing with us. There are folks who have deep real estate experience who want access to our deal flow. And there are folks who have never made a real estate investment ever in their entire lives. So it's really varied, and I think that's the really powerful thing about the online component, is that you can reach such a broad network of investors across a broad range of geographies, which we're seeing and we're experiencing.
I see a big data opportunity. But
We don't sell data.
keep it for yourself. Right?
Yeah,
So you don't know. But when you say you screen vigorously, tell us what that means.
So every time that an accredited investor invests with us, we've screened that accredited investor 4 times. So we have a 4-time policy at our company, which is that they've gone through our accreditation policy a minimum of 4 times. We'll make connection with that investor. They go through our online channels. We are not currently relying on the Jobs Act. So we're operating in the Reg D world, which Adrian talked about, which is sort of pre-Jobs Act. But we make sure that we're working with accredited investors, and we make sure that these are folks who understand the risks involved with our transaction, can afford to lose money should a transaction go bad, and understand what they're getting themselves into. I mean, some of our transactions will be a 10-year transaction. We don't want somebody who expects to have that capital back in 6 months.
Yeah, so our platform is also exclusive for accredited investors, and we have our own process of vetting those investors. We also work with companies that do, so there's 2 offerings under Reg D. One is 506B and one is 506C. 506C is with use of general solicitation. So for those, we have a separate process that we go through to verify the accreditation of our investors. It requires going another step further, which we take on the onus of that for the companies that we work with. A large portion of our investors, again, are investors that understand consumer, whether they're longtime consumer investors or people that have been operators at consumer product companies, people that have exited from their own consumer companies and can help these companies beyond just raising capital. And then the other thing I'll mention is that companies that raise with us, they can decide which investors on our platform see their information. And so we also allow our companies to have a filter when they're deciding which investors can access their documents.
I'll add a few more things about our investors, just fun. So when we began, about a third of our investors were doctors. And it turns out that they either owned clinical practices, and they made wealth on that side, or they were just high-paid clinicians, cardiologists, radiologists. And then we had some oil and gas guys, some real estate guys. When we went online, wow, the mix has changed. And we need to do some work to actually fully understand who all these people are. And we spend a lot of time on the phone with them. When we verify them, we go through our own process. We have to get culturally comfortable with them. And then we give them the Goodwin Proctor, sorry, not Dorsey, Whitney, and have them run their own process to also make sure that they're accredited with some of the policies we have. And so on the individual side, I think it's evolving, it's interesting. We're also beginning to get interest from big public companies that say they'd like to co-invest with us in areas of interest to them. For example, digital health, which is not a place that I'm super excited about investing in for various reasons. But the fact that big corporations with big balance sheets see value in the kinds of things we do, we had never planned on that. And we haven't taken them in yet, but I think clearly they're going to become part of our investor base. That's kind of exciting.
That is very interesting. All right, so let's get to the next part of my set of questions, which is let's look at how you actually help entrepreneurs get successful outcomes by working with you on your platform. I'm going to ask another set of questions and just ask you to please respond to them. What should companies consider, and thank you, Katie, a lot of questions came from her, when they select a crowdfunding site? What should they consider? What should they think about in terms of...
All right,
It's all you.
So in terms of what companies should consider, a few things to keep in mind. One, choosing the right platform is important. You've got different types of platforms represented here covering different sectors. And so we think having a platform that focuses on what your business focuses on is important. And so we focus exclusively on consumer product companies and retail companies. And so we find that by having that focus, we're able to attract the right types of investors for those companies. So looking at what sector the platform focuses on, another big thing to focus on is how that platform can help you beyond just providing capitals or providing a source of capital. So we have templates that companies can use in their offering, which helps reduce legal costs. Although they are still highly necessary and you would still need to use an attorney, you have a starting point. We also have a lot of partnerships that help these companies beyond just their capital raise. So we're partners with large CPG companies like Procter & Gamble, General Mills, and those CPG companies will actually hold incubator days with companies that we work with and provide them with valuable advice. We also have partnerships with service providers that add value to the companies with free services or reduced rate services. So what else the platform offers is important. And then how secure do you feel on that platform, I would say, is another big one. So do you feel like your information is protected? Do you feel like they have accredited investors only on the platform? Do you have the ability to screen out certain people from seeing your information? So I think those are some key things to consider. And then how is the platform actually functioning? So we're a broker-dealer, which allows us to do what we're doing. Other folks have different models, so just understanding that and how you fit in with that.
And talk about structure evaluation and how can they be successful in fundraising?
Sure. So, I mean, you're going out to investors when you go on these platforms. And so having a structure and evaluation that makes sense is important. We don't set the structure and we don't provide advice on valuation, so we rely on the companies to do that. But having something that is in line with market and that will get investors interested is going to be critical to actually raising capital. especially if you want to target sophisticated investors that can add more than just a check to the business. They're going to be able to compare this to other deals on the market, and if you have something that's not in line with that, then it's probably not going to happen. So if you're actually looking to raise capital, having something that's interesting to investors is really important. Convertible notes is something that you asked about, and that could be interesting for other companies if you aren't ready to do a priced round, or if valuing the company today is difficult. Convertible note can be another tool to use. So thinking through the different structures, having an attorney that can help you through that process is important.
Yeah, I think Katie touched on a lot of really important things. For me, there's sort of macro and micro. On a macro perspective, you're looking at the platform. Has the platform actually done this, right? Do they have traction? Have they funded, XYZ properties, for example, in our space? And the other thing is, I'll go back to culture. One of my big concerns about crowdfunding right now is that you've got a lot of folks who are on the C-suite that are marketing, or their background is technology, and that really scares me. Really, it's really, really scary to me, because this is a financial services business, and you want CEOs and COOs and CFOs who come out of financial companies and who understand that they're selling securities, who understand the risks, and who can really share that with investors. So that's something I think is really, really key to look at. As far as terms, in the private real estate investing world, I think it's probably one of the most fragmented asset classes. There are transactions that are being done at all kinds of crazy terms, all kinds of great terms for investors, all kinds of terrible terms for investors. I think that we are actually the first company in the country who has aggregated this information. We released a thought leadership piece after we'd underwritten $375 million in private real estate transactions, and we went public with it. Don't force any of our real estate companies to price their transactions a certain way, but we've at least provided them with what guidance is of market. Frankly, a lot of these real estate companies don't even know what market is, because they don't see the amount of deal flow that we see. We published that a couple of months back. We've now seen over $700 million in deal flow. So we're planning on republishing that and updating it. I mean, every so often these numbers change and the markets shift. So we do provide market guidance, though we don't provide specific guidance for their transaction, though we're also educating our investors. So if investors know what market is and the real estate company comes in at something that is under market, it's not going to be a good alternative or a good outcome for anybody.
So
Let me force Jilliene to answer this last question. What makes a company successful in a capital raise?
So our platform is a little bit different. We don't mandate that the companies go out and raise a bunch of their own capital and route it through our platform. We're really bringing them a new source of capital with our thousands and thousands of accredited investors. So for us, it's about their track record, number one. It's about the transaction. Is the transaction have strong cash flows? Is it something that investors actually want to invest in? It's about how they present on a webinar. So can they talk about the transaction? Do they sound smart? Do they know what they're talking about when they get hit with really challenging questions from investors and from professional real estate investors who are in our database? And I also think that another element of it is patience. This is a new market, and the first time that we do a new transaction with a real estate company, there's a learning element, right? We have to explain what it is. We have to teach them about crowdfunding. But our model is doing repeat business. So we've now done multiple transactions with the same real estate companies. Now that they know us, they love us. They just say, we want to do another transaction. It still goes through our underwriting. We'll still turn away a handful of deals for every deal that we'll do for that one specific real estate company. But I think it's a combination of things that make them successful.
Let me dig in just a little deeper.
Sure.
I've done real estate transactions, investing, advising, fundraising, all of that stuff in the last 5 years.
Mm-hmm.
And I came to a very simple conclusion.
Creating a real estate company. We're looking for companies that have been around for a really long time. I mean, we're working with one of the largest real estate companies in the Midwest right now. They've done $3 billion in transactions. I mean, they're a meaningful, well-established real estate firm who finds that raising capital with us is just frankly really easy for them. And it's easy for them because they've got the history, they've got the track record, they've got a great deal flow, they sound great on webinars, they're happy to meet with investors, they're happy to take questions from investors. And those are the kind of brands and the kind of businesses that we want to affiliate ourselves with, are really folks that have deep history, deep track record, but they didn't have exposure to our investors, right? I don't think they'd ever taken an investor from California before they did a transaction with us because they're so focused in the Midwest, and now they've got handfuls of investors in California and New York and Texas and sort of all over the country through the exposure that we've been able to give to them.
Thank you. Andrew.
Jilliene made a lot of great points. So I'll add a few small like tweaks to what has been said. Great things have been said. I think as an entrepreneur, you should think about what kind of capital you want. Is your company a VC appropriate company? Are there other ways to do it? And what kinds of VCs you want in the deal? I think our model, again, it's like Jilliene, it's really complementary to a current model. We're not trying to displace venture capital, at least not initially. We're complementary to it. And we're extra capital coming into a deal. So what kinds of deals are really the deals we want to see, and which entrepreneurs do we want to partner with? This deal we did in April, Dan Burnett's company, Channel Med Systems, he was trying to raise $8 million. $15 million was trying to get in. And Dan said, wow, I love what you're doing. To the extent that I can get less dependent on conventional VCs, and by the way, I'm also a conventional VC. To the extent I can get less dependent upon conventional venture capital, I want to see that model work. I want different sources of capital coming into companies which have deep pockets. And one thing we haven't talked about here, but we found with our model that when we get into a deal and the deal begins to go well, no surprise, a lot more capital tries to get in. So when the next round happens, our portal has very deep pockets. I mean like 4 times pro rata deep pockets. There's no fund cycle. There's no dry powder going down at all. So we have more cash to move into these deals. And I love that. As a venture investor who raises venture funds and invests and raises other venture funds, having a model which is independent of the fund cycle and the entrepreneurs love a different way of getting capital into the business, I think those things are great. And so I guess one thing to tell your entrepreneur friends, if you have an amazing company in healthcare, we'd love to talk because we want to get into really exciting deals, bring our investors in, and I think that this portal has low maintenance, deep pockets that are a nice complement to a VC board. VC boards are great. We add value, yada, yada, yada.
So let me dive in a little bit, Andrew, with your model. Jilliene is working with deeply experienced operating companies that have long history, track record, billions of dollars deals. Katie is working with companies that are early stage, relatively early stage consumer goods companies, right? So typical startup as we think about them. But what is your sweet spot for your online, number one? And number two, how do you handle the right brain, left brain? I'm a traditional VC, I'm an online VC. What the heck are you doing? Which one resolves to be number one?
So first of all, we're solving for capital, right?
Okay.
Really, all of us, Talat, Mir, and I, and Mar, we're doing this because we love life science innovation. And it turns out solving for capital around life science innovation is a very exciting and interesting place to actually be very creative. So that's kind of where we're coming from. Right brain, left brain thing, I don't think that way. I view this all as just ways to solve for capital. We're the first venture fund to do this. As far as I know, we're still the only venture fund to do this. But I really doubt we'll be the last one to do this. This makes all kinds of sense. And the fact that it's so much easier to mobilize capital from this source than it is to get conventional LP money, it's kind of unbelievable. So I don't view it as right brain, left brain. I think the real issue is how involved are you going to be in building and guiding these companies, right? Because when we run a venture fund and we charge fee and carry, we take board seats, we're very active. We're very active in these companies. And we get in things that are early, mid, and late stage, but in every case, we're getting involved because we see a path for that company and we're going to help them achieve that vision. And if we don't agree, we don't invest. The portal is a less involved model. The portal doesn't necessarily take board seats. And so the kinds of deals that we're going to be getting into, we want to have smart people around the company, good VCs, but the portal in those cases will simply be extra capital at the table. They may not be a board seat. So this is actually evolving, right? Where we go with it, we'll see. This began as a spin-out from our venture fund, but as the portal scales and grows.
But 11.7 million has been raised on the portal.
Yeah, on the portal and the offline version of it, yeah.
How many deals? 6 deals?
6 deals.
Okay. So what series, what stage of growth have
Yeah.
you done?
So has anything been a Series A? No Series A's, right? Yeah. All right. So basically Series B like Series D. So nothing's actually been a de novo early company, even though that can happen and certainly will happen. So yeah, more. But everything we do in healthcare, by the way, I mean, to you folks, it's probably very early stage. Our companies often get bought prior to any revenue. So in my world, when I say late stage, it's a clinical trial milestone, not a revenue milestone.
Yeah, reminder to the rest of Silicon Valley folks, Series B to D in life sciences are very different than
Very different.
IT.
Yeah.
That said, any of it was follow on to your traditional side?
Oh, absolutely. This is how it began. It began because our limited partners began wanting to invest alongside us, and they began to get more folks around the table trying to co-invest with us. I mean, this happened. I'd like to say we were brilliant and we just had this incredible idea, but we didn't. We had high net worth folks who wanted to do this, and they kind of pushed us into doing it. So that's how it happened. It began as an adjunct to our venture fund.
I hope this is the first public event that you have done, because folks, you saw it here first. I would say this about that. When I engage with VCs to talk about this series and to invite them to be on the panel for a variety of things, many of them tell me, we don't see this whole crowdfunding thing affecting us.
Right. Except when we're getting into their deals, then they have a reaction.
Yeah,
Like this
so
deal in
I
April,
find this really
there was a
insightful.
definite strong reaction. The VCs were like, what is going on here?
Applaud you for the
So-
creative thinking. Okay, so angels often say they bring more than capital to the table. And companies expect to access more than just capital through crowdfunding platform. Katie, you began to allude to that one.
Yeah, I think I touched on this a bit, but we at CircleUp and we believe other platforms have a lot that they can leverage as well, especially people that have started these platforms and have been in the industry for a while, at least the industry that they're serving. And so our partnerships with large CPG companies and service providers to help those companies, introducing companies to relevant investors, so people that can provide advice beyond just providing capital. We've had investors that have joined the board. I think this also kind of touches on something that you were saying, Andrew, in that, you know, at CircleUp, we're not taking a board seat and we are not an investor. And so we look to our investors to help these companies after they have invested in them. And so whether that be being a brand promoter or helping the company think through international expansion, helping with PR. I mean, we've got a lot of really great investors out there that have different skill sets, and that's one of the...
Ask them to submit a bio?
Sorry,
As part of the qualification?
So companies can filter who actually gets to see their information, and they can see the investor's LinkedIn, what kind of background they have, and then they have profiles on our site as well. Yeah, yep. And then we've also seen some examples where someone wasn't a clear consumer person, but was able to help the company in some way. So an example would be someone that is in PR, helping the company to get some really great press coverage, wasn't a consumer-focused person, but invested in the company, then had an economic incentive, became a brand promoter, and actually helped that company with their PR. So we've seen a ton of value add from investors, and I think it's a way to kind of take on what sometimes the VCs provide, and so we look to our investors to add value beyond just that capital.
Jilliene?
Yeah, I think that there's definitely things that the crowdfunding company can provide to the real estate companies. I talked about this already, but for us, it was helping them price their transactions, right? They didn't know how to price their transactions. They didn't know what market was. So we came out and said, here's what market is, and now you can use that information to price your transactions. Another story of a specific investors of ours, we recently closed on a fairly sizable transaction outside of San Francisco. It was a retail shopping center, Safeway, CVS, Subway, McDonald's, some really big brand name tenants, great cash flow, hopefully will be a fantastic transaction. And it's 25% vacant. So there's an office space which is on this retail shopping center that is vacant. And one of our investors invested in the transaction, and after it closed, he emailed me and he said, I know 3 businesses that would move into that center. I live 10 minutes from the shopping center, I work 10 minutes from the shopping center, and I know a number of companies that you guys should talk to. So we introduced those companies to the leasing agent at the shopping center, and more remains to be seen. But that's a prime example of when you've got local people who are investing in the real estate surrounding them that can add value, right? This gentleman happens to be a thought leader in the local community, knows a lot of folks, knows a lot of business owners, and is potentially going to help us with the lease up. So an interesting example when you give individuals access to a type of asset class that they wouldn't have historically. Like, there's no way this guy could have bought this shopping center with Safeway and CVS and Subway by himself. But with us, he's an owner in it, he's vested in its success, and he's making meaningful introductions.
So Andrew, those 200 pages of questionnaire, you say, how do you help me?
That's all just legal disclosure. Very, very important stuff, though. They have to read it all thoroughly, and they do. I think the question of a value add is interesting. When I was an entrepreneur, I really didn't see much value in my board. As a VC, of course, I see lots and lots of value in the board. So I think people laugh because it's kind of true. I think the one thing that we bring to the table, and that any good investor should, at least in healthcare, would be relationships. So our investors also include former executives from the Medtronics and Eli Lilly's of the world, and our LPs. I mean, Lilly's gone public saying they're an LP, and other medtech firms are LPs in our fund. We know the people who run the pharma companies and medtech companies that acquire these companies, and we can help the companies get involved and understand what they need to do in terms of milestones to create value in a way that makes sense on the acquisition side. And again, healthcare is an unusual business. It's not this tech thing. We have to generally plan to either build a standalone business, always a good plan, or something that's going to be acquired for a premium from one of the big players, which means have a standalone plan and understand what the M&A scene needs. So that's what we do. That's what all good investors should do. So that's what our portal brings to the table now. As it evolves over time, I can see already we're going to get more like CircleUp. We're going to have folks who are just smart investors in and of themselves who want to engage. A lot of our investors now who are very seasoned executives, they want to invest, but they're not always clamoring to be around the table or get a board seat. So that side will evolve a bit, but the founding team, we're VCs, it's what we do, and I think our value is really around relationships and guidance around building value to exits.